Welcome on board, Naresh, as well as Anshul Sehgal too. Anshul, hi, afternoon. What would you attribute the weakness this week to? Because, in terms of cues, pretty much all of it has dried up until Jan, when we're going to have the earnings kick in, and then, of course, the budget and so on and so forth. What explains the weakness then?
Afternoon, Aisha. Good to be talking to you. So if you look at what has happened after the month of October and November, which is that in that period we saw meaningful correction in the markets, and then the markets rebounded a little bit, and then again we are seeing this jitteriness in the market today. This is largely because of macro factors and also the fact that markets don't have room in terms of valuations to see further upside in the short term. Of course, if we take a longer term view, say a 2 to 5 year view, that's where upsides can be meaningful. But having seen such a large move in the markets over the last, say, 1.5 to 2 years, markets are taking a breather at this time. And in a sense, this is healthy because there were many participants in the markets who were of the view that it is very easy to make money in the markets. This will be a wake-up call for many of these sort of participants. And in the coming year, as we speak today, it is quite evident that this market will kind of separate the men from the boys. It will be very difficult for broad market players to make money. This will be a market where stock-specific moves will be quite evident. As Srishti mentioned just recently, one stock is up 6 to 7% on a day like this. And we will see elongated moves in stocks where you will see the markets correcting, but there will be stocks which will be doing well. Identifying those stocks will need skill, and which is why you will see a wheat from chaff kind of separation in the year ahead. That's how we see this market playing out, and it's not going to be an easy market.
It's not going to be an easy market, but Anshul, I also want to get your take on ABB India as well as Siemens, because like our colleague Ria was also highlighting that what is the likely reason for today's fall. But Anshul, look at the valuations these stocks are trading. 1 year forward valuation close to 80 times. Do you still justify this? Are you able to justify these valuations, or there could be some more weakness in the times ahead?
Srishti, I made a presentation recently to the CFA Society, and there I explained valuations in the context of real estate. Now, since you and I are in Mumbai, we understand Mumbai real estate. If we get, Malabar Hill properties at Worli prices, even Worli prices on an absolute basis are not cheap. But for Malabar Hill, those prices are cheap or reasonable. But if we get Malabar Hill properties at say, New York prices, Manhattan prices, then clearly that is expensive. Even though the property is Malabar Hills, but still you're getting it at expensive valuations. Now, it is the judgment of investors which decides whether a company like Siemens or an ABB, which are really high quality companies, should be trading at 60 times or 80 times, and at what level is fair valuation. Now, clearly, having seen significant market valuation uptick in these names, room for valuations to go up remains limited, and disappointments in expectations will lead to cuts, as we have seen recently. That is today, in fact, in one of these names. Long term, again, capital goods as a space has significant room for upsides. But short term, really, they are full on valuations, and there is no room for a disappointment in these names.
Okay, no room for disappointment. Kunal, what does it seem like? Does it seem like today's correction is actually throwing up opportunity to buy into any of the cap goods names, or would you say wait it out? It's a very sharp decline. We could see some follow through.
We should see some follow through, especially for likes of Siemens, because we've seen historically that in the last 9-10 months specifically, the stock has taken resistance 3 times, and all 3 of the attempts were very strong major uptick zones for Siemens. That was just about that 7,900 to 8,000 levels for the stock, and on all of the 3 attempts the stock had fallen back down towards 6,500 mark. Currently, it's at 6,900, 7,000 levels, which means potentially, even if you look at a retest of the previous lows, the stock should come back to that 6,500 levels. But my concern is that today's breakdown for the stock is on the back of much higher volumes than what it had been in the previous two attempts when the stock had reversed from that 8,000 levels. That could generally indicate that the stock should be looking to correct further from that 6,500, which is the triple bottom support for Siemens. So I think in either of the cases, I would believe that the stock should correct further from current levels, and I think one should not be in a hurry to buy the stock.
Okay, don't be in a hurry to catch this falling knife that's playing out currently in cap goods. Not just Siemens, but that's rubbing off on the likes of ABB and the rest too. We'll take a very short break on that note. When we come back, we'll continue tracking markets. Currently, of course, we're at the session lows on the index. Trades right here in ET now. Let's just take stock of where the market is settling in at, and definitely it's been one of those freaky Fridays. We're now down a good 330 points. In fact, on the Nifty futures, we're at the session lows right now. 290 points gone for the spot as well. 23,688 is where we're currently at. In fact, barring a DRL and a Nestle, I can't really pinpoint any such movers as well. It's pretty flat for JSW Steels and Titan, if you will. Tech M, Innocent Bank, Axis, Trent, L&T, M&M, TCS, SPI. These are your big contributors to today's loss. Even Reliance, for that matter, for the last two consecutive sessions, that's been weighing heavy on the markets. It was a 2% decline in Reliance yesterday, and today as well, another 1.5% gone. Naresh Mirani too joins in on the show right now. We've still got Kunal Bothra and Anshul Sehgal on the show. Naresh, what is it that you're making of the weakness, particularly when it comes to the Nifty Bank and, of course, Nifty IT as well, which is a big sectoral laggard today?
So IT has been a surprise in the sense that there was expectation of some bit of an uptick today. We've got sold into it. So looks like a profit book across the whole IT space. So for now, expect a retest of the last breakout for Nifty IT. So wait it out. In terms of banking, that's also been a surprise. The whole rally was supported by banks, and now we are back to square one. So for now, we keep on watching those levels which were made in the last 2 months. So 23,200 on the Nifty, roughly 50,000 on the Bank Nifty. Till the time that they hold, we continue to remain in this consolidation.
Right, so continue to remain in the consolidation range when it comes to the IT. But Kunal, if you can help us with your take on the mid and the small end of the market, because there the correction is quite sharper in today's trading session. They too, both the index are too on the day's lowest point. But given the kind of candle in the formation that these index are making, is it a sign of more worry?
Yeah, it definitely is, and it eventually boils down to mid caps and small caps. They also just get aligned themselves with the market mood. So right now, for example, what played out over the last say this 1,500 point bounce for the Nifty was even the mid caps and small cap indices, which were trading at their 50-day and the 200 moving averages. These indices had come back into a bounce process. Small cap index, in fact, made a fresh swing high for itself. But then I think right now, when we are looking at the Nifty sub the 200 moving averages, both the Nifty small cap and the mid cap 50 index, I think they're still at a zone of 4% to 5% broadly above their long-term moving averages, which means that the second round of selling, whenever it happens into the indices, should be felt more into the mid caps and small caps.
Okay, should see some more pain when it comes to mid and small caps. But Anshul, where within the current market decline are you seeing actually opportunities to buy in? We've been chatting with a lot of experts, and they believe that next year could perhaps be a comeback of staples, for instance, or for that matter, the larger consumption segment with the likes of some of the paint stocks as well, which have fallen, along with, of course, FMCG, and they may actually bottom out. Where are you scouting for opportunities?
Aisha, if you listen to con calls, quarterly con calls, and you get cues from those calls, one thing that is quite evident is that the rural consumption and tier 2, tier 3 town consumption seems to be turning around. That is something that companies in unison have indicated. And if we look at companies that cater to this demand, mostly that demand is catered to by companies like the FMCG, like value retail, consumer durable companies, and the like. And then if you look at valuations in in that space, mainly because of weakness in the rural economy. Over the last, say, 2 to 3 years, valuations have consolidated here. In some instances, as long back as 4 to 5 years, valuations have consolidated. Given that, it is quite evident that this is one space which may become interesting in the coming year because demand is turning around, valuations are reasonable. Second space that one should look at is banking. Pick a bank and you will find, particularly in the PSU banking space and the second rung banks, you will find companies trading at 5 to 10 times price to earnings, around 1 time price to book. I don't recall the last time I saw a bank like HDFC Bank trading at 2.5 times book and under 15 times price to earnings. Now, those are the kinds of valuations that we find in financials. Even NBFCs, certain NBFCs have become interesting. And then there are enough and more stock picking opportunities in the broader markets, whether it is capital goods, manufacturing, whether it is alcohol and alcoholic beverages, or other FMCG plays and value retail plays. There are enough and more opportunities that one can identify. So this is a market which will require some skill, but in our judgment, there are money-making opportunities in the year to come.
Thank you so much for highlighting the sectors that one could be eyeing at and the areas of opportunities as well as per you. But with this, we'll let you go on that, and thank you so much for taking the time out and speaking with us. But let's get back to some of the ideas coming in from our techies then. And Kunal, if you can help us with some of the stocks that you are eyeing at in this weak market, are you still scouting for some buying opportunities?
So, from the closing trade perspective, Petronet is something which is looking attractive yet at current levels. The stock is perched at a breakout just about the 340 plus levels. So, looks like the setup has been a lot more stable for Petronet. So, that's a stock which I would look to trade in the closing.
Okay, Naresh, what about your strategies?
Out for defensive, Lupin is the one which is holding on even in the current markets, close to the breakout point. So, looks interesting for a move to 2250.
Let's take a very quick break before we step into the last half an hour of this trading week, and time now for some interesting opinion on the markets as well. We caught up with a whole host of experts and figured out what they think the year ahead is going to be like. Hear it out from Gautam Shah, Navneet Manot and Shankar Sharma.
Real estate and metals. I think the way DLF has come back, Loader Developers has come back, Shobha has been sustaining. I think real estate is going on to make new lifetime highs and beyond. And metals, I think after all the news flow that we got from China, is just setting up for a move back to lifetime highs. So these two pockets of the market, we remain quite positive.
In next 20 years, China will lose 20 crore people in its workforce because of the aging. And now the population has started declining. India will add exactly the same number, few million here and there, 20 crore people to its workforce. So 20 crore addition and 20 crore deletion. So if somebody has to produce now, despite all the efforts that Trump will make, and I'm sure they will have some success on reshoring or friendshoring and whatever. But India really has once in a generation, once in a lifetime opportunity to get manufacturing back.
Big top-down, gold appears to be a fantastic structural trade due to a variety of reasons. Too long to go here, but I think it's a secular trade. Investing in tech within India itself, because I do believe that companies that are leveraging AI, leveraging stuff like that, will be huge winners.